In this week's video, we'll review the latest charts to help us answer the question, are the charts starting to drift from the soft landing bull market script? We'll be moving quickly, so feel free to use the pause button on your video player. The entire video is being recorded at 7:30 p.m. Eastern Time on Friday after Jackson Hole. Here are some of the high points that we'll be hitting this week. You may remember on August 5th, which was a Monday, the Nikkei crashed about 12%. The VIX in the U.S. spiked to 65. Having said that, relatively early in the session, it looked like buyers became interested in the technology sector. And you may remember in last week's video, we covered the table on the right side of your screen, which leaned heavily back toward risk on. Fast forward to this week, Friday evening, August 23rd, after Jackson Hole, and after Chair Powell signaled to the markets in no uncertain terms that the Fed is going to start cutting rates, as we discussed in recent weeks. And the market responded in a big way, including delivering a 92% update, which means 92% of the volume, for the most part, on the NYSE exchange was associated with advancing issues. What does that tell us? That tells us, really in no uncertain terms, as of Friday, August 23rd, and after the Fed signaled to the markets that they're getting ready to cut rates, large institutions are buyers of stocks, which tells us they don't place a very high percentage in terms of odds on the imminent recession theory. Now, do the charts back that up, or are some of them starting to contradict that? And that's important because if we avoid a recession in an environment where the Fed has telegraphed rate cuts, and they can do so in the coming months at a relatively measured pace, as we've covered in recent weeks, lower right-hand corner of your screen, stock market performance walking forward in those instances where they're not cutting rates at a rapid pace, the stock market performed extremely well after the first cut, looking at 1 month, 3 months, 6 months, 1 year, and 2 years. Results shown are for the NASDAQ Composite. So we currently have a new client window open. As we noted in recent weeks, the secular volatility model was created for this type of client. So let's talk about conceptually, from a very high level, how it works. And we're going to be using a very simple chart to illustrate basic concepts used in the model, again at a very high level. This is the 200-week moving average in red. This is the 20-week moving average in orange. And then we have the 30 in blue, the 40 in green, and the 50-week moving average in pink. Now, if you've been watching these videos for any length of time, you know this is a weakening trend look. We go from a full-bore bullish look here in 1929 to an indecisive and weakening trend look here, and then concerns increase significantly when we breach the 200-week moving average in red. This is about mid-year 1930. And with that concerning profile that we could see, measure, and put in a model, really bad things continued to happen. The Dow Jones Industrial Average from this peak in 1929 to this low in 1932 lost approximately 89% of its value. And we can clearly see the transition on the left side of the chart. This is risk on to the indecisive and weakening trend look to risk off here. And all of that can be seen before we enter 1931, where it starts to get really, really painful into mid-year 1932. It's the 1973-74 bear market, and eventually we're going to compare all of these periods, some good, some bad, to the present day, August 2024. You can see the visible deterioration in the trend here from 1972 into early 1973, and with this very vulnerable look, bad things continued to happen. Now, visually, the fact that the market doesn't try to retake the prior trend here and looks extremely weak, that is concerning. And this is concerning here and here, where you're rejected by the moving averages that previously acted as potential support. Again, a very vulnerable look in this window here. Before it was over, the S&P 500 lost approximately 48%. And notice at the end of it, we've got a full-bore bearish look, with red, the slowest moving average on top, orange, the fastest moving average on the bottom, price below all the moving averages, and the slopes are all down. It's in stark contrast to this period up here before the bear market began. So before we go to the 1987 example, remember this look here in November of 1973, what these moving averages look like and where price is, and contrast that with the look of the same chart with the same moving averages in August of 1987 before the crash. This is a very strong trend look. It's a full bore bullish look, with orange the fastest moving average on top, red the slowest moving average, the 200-day moving average on the bottom, prices above all the moving averages, and the slopes are up. And while the strong trend wasn't particularly helpful at face value, when the market crashed 34%, it was helpful because all of this waterfall decline takes place above an upward sloping 200-week moving average, and even at the weekly low in here, this is December 4th, 1987, it's not a lot of damage to the long-term trend. And a lot of times when you get a plunge like this, the market recovers and resumes the prior trend. Very, very similar to what happened before, during, and after the COVID crash. Here's what a very strong trend looks like. This is 1995 here. You can see we have a full bore bullish look. Look how far away price is from that upward sloping 200-week moving average. And look how long a strong trend can last. All of calendar year 1995, all of calendar year 1996, all of 1997, and into mid-year 1998. Now contrast this look here, moving averages and price in 1995, with this extremely concerning and vulnerable look here in the second half of the year 2000. A moving average cluster that's tight and it's rolling over, prices drop below, and then prices rejected below the moving averages. Concerns increase when you make this lower low in here relative to this low here. But thus far, all of this is happening above an upward sloping 200-week moving average. Concerning, but not yet overly concerning. Well, that didn't last long. And this is a concerning look here when we can't retake these moving averages. And really what this is in here, it's the polar opposite of what happened today, the 92% up day, indicative of institutions accumulating stock. This is heavy distribution in this window. The institutions looking forward, and they're heavy sellers of stocks. So even at this point here, we have a strong trend look with the 20, 30, 40, and 50-week moving averages, but it's a strong bearish trend look. And once again, at the end of it, you end up shifting from a full-bore bullish look over here in 1999 to a full-bore bearish look at the low in 2002. So typically, in these deflationary bear markets, a traditional bear market, especially the ones that last a long time, it's a lot different from the waterfall plunge in 1987 and a lot different from the COVID plunge. In a deflationary event, you typically can migrate to defensive assets and mitigate this drawdown and eventually potentially make money. How is that possible? Let's use the financial crisis case as an example and a way to answer that question. Clear deterioration in here. By mid-year 2008, price has not been able to retake these moving averages, and we've gone from pink, green, blue, orange, and then we flip them to orange, blue, green, pink. Again, we can see all of this in here before the last leg down, the serious leg down. We have all of this deterioration in here before Lehman Brothers collapses. In fact, by the time Lehman Brothers collapses, the 20, 30, 40, and 50-week moving averages are starting to slice through the 200-week moving average that's starting to roll over in a concerning manner. This looks a lot different from this strong trend look over here in May of 2007. The stock market didn't peak until October of 2007. So in this case, you'd be running mitigation 2. And part of that strategy is you're migrating to defensive assets. In a traditional bear market, a deflationary bear market, defensive assets such as bonds, long-term treasuries, TLT, 7 to 10-year treasuries, IEF, can do extraordinarily well. Why? Because when prices are falling in a deflationary environment, You basically want to try to lock down your yield. That's what you do with TLT. And bonds benefit from market participants anticipating the multiple Fed rate cuts that come in these windows. So when SPY is down between 40 and 45% here, TLT is up over 40%. IEF is up approximately 30%. So in mitigation 2, again, you're trying to not only get defensive, but then migrate to opportunities in this type of environment. That's not what happened in 2022. That's an inflationary bear market, and it's different, and hence one of the reasons why we developed the secular volatility model. In this entire event here, how long it takes, the extent of the damage, the performance of bonds relative to stocks, it's quite a bit different relative to these waterfall plunges. These are mitigation 1, where you're basically acknowledging the longer-term trend may be on the ropes, but based on what we know today, most likely the market's going to right itself and eventually go on to make a higher high. And that's what happened in the 1987 case, and that's what happened in the 2020 COVID place. The market makes a stand at or near an upward sloping 200-week moving average. That is not what happens here in the 1973-74 bear market. Hot knife through butter look here in Q4 of 1973. The market doesn't bottom for approximately a year after that. It's not what happens here. Again, a pretty convincing slice through in 2001 with a deteriorating look, and after that, really bad things continue to happen. And well before Lehman in here, we're already flirting with the 200-week moving average, and eventually we slice through it. Now, I want to emphasize, these are not the charts used by the secular volatility model. These are not the moving averages used by the secular volatility model. We are using these moving averages to illustrate basic concepts. And these basic concepts are used by the secular volatility model. Thus, in the present day, a fair question to ask is as follows. Does the present day look like it's morphing into something like this that we would be concerned about, where the 20-week moving average is now dropping below the 30, 40, and 50-week moving averages as it did here in early 2008, and is price potentially flirting with dropping below those moving averages? Or do we look more like this period here, this very strong trending period in 1995, where price is above all of the moving averages? The orange moving average, the fastest, is on top, the red moving average is on the bottom, and the slopes are all up. Or are we starting to look something like this, telling us we might get a waterfall plunge similar to 1987 or the COVID crash? If we objectively look at the present day chart and answer all of those questions and select the best alternative on August 23rd, 2024, the answer is today looks most like 1995. In fact, you can make an argument that coming down here in Q4 of 2022 and making a stand at or near an upward sloping 200-week moving average, and then making a stand again in Q4 of 2023 at or near an upward sloping 200-week moving average, looks similar to this period in here. So 1994 looks somewhat similar to 2022. The Fed's raising interest rates. There's a concern about inflation. And then in 1995, the Fed has pivoted and it starts to cut rates. Price makes a stand at or near an upward sloping 200-week moving average. You go from an indecisive look in this window here to a strong trend look. You go from an indecisive look in here in Q1 of 2023 and morph into a strong trend look. And if we zoom in somewhat like the 1995 to 1998 window, look how far price is above the 200-week moving average. Look how much white space there is between the 20-week, 30-week, 40-week, and 50-week. That's what a strong trend looks like. That doesn't look anything like this scary turn here after the peak in October of 2007. And it doesn't look anything like this scary turn here in Q4 of the year 2000. And after that, really bad things started to happen. And it does look similar to this point here in 1995. Now, we're not saying 2024 is 1995. No one has said that. The market takes all topics on all time frames into consideration. That's reflected in this chart and in the exact same chart on August 23rd, 2024. This looks like a market that's not particularly concerned about an imminent recession and a market that knows the Fed's getting ready to cut rates. And if that's the case, historically, as we demonstrated a few weeks ago, that typically is very advantageous for stocks. And in 1995, this looks like a period when institutions aren't particularly concerned about a recession. 1995 is a soft landing scenario. And the August 23rd, 2024 chart here relative to hard landing versus soft landing probabilities also aligns with something that happened during Friday's session, August 23rd. A 92% up day. That shows high bullish conviction. It speaks to expectations about future economic, Fed interest rate, and market outcomes, including earnings. Let's take these same concepts, same moving averages, and look at all of the S&P 500 sectors to help us answer the question, how broad is the current bull market? We'll walk through each one of these sectors individually. You can see XLC has gone from an indecisive look in here in 2023 to a strong trend look in isolation. XLY, kind of all over the place. But if you look at this objectively, compare this region in here to the improvement in this region here to the even better improvement in here. How can I say that? Well, in here, price is below the 200-week moving average. In here, price tends to make a stand around the moving averages. And after this point here, price tends to make a stand above the 50-week moving average. Look at all this white space in here. We don't have any white space back here. This is an incrementally improving trend. Look, not one of the strongest trends. Consumer staples. The longer a market goes sideways, 2022, 2023, the bigger the move that we can expect to get when the market either breaks out in a bullish manner or breaks down in a bearish manner. We're evolving into a strong trend look over here, somewhat similar to 1995. The fact that the energy sector doesn't look particularly strong here tells us market participants aren't overly concerned about inflation, but it's still in a long-term uptrend with price consolidating and moving higher above an upward sloping 200-week moving average. What does this say about the health of the banks? The financial sector, XLF, just broke out of a long-term base. It's making a new weekly high here this week on August 23rd. And look at this. This, too, looks similar to the improving look in 1995. Right here. This looks similar to this. Defensive healthcare just broke out of a long-term base. That is an improving look here. It has a full-bore bullish look, not a strong trend look, but unquestionably an uptrend. Similar situation with XLI. Look how much space there is in here indicating the strengthening of the trend relative to all of this back here in 2023. Materials, in the process of breaking above this base, consolidating above the base in a healthy manner, and starting to push higher. All of it occurring above an upward sloping 200-week moving average. And the real estate sector hasn't made a new high yet because this is a major laggard. But what does this tell you? This is like the bond market breaking out. It tells you that this sector heard loud and clear that the next move for the Fed is going to be to cut rates, and most likely it's going to be more than one cut. And that's good for the interest rate sensitive real estate sector. One of the strongest charts still, the tech sector. Look at all the white space between the moving averages in here. We're well above a strong upward sloping 200-week moving average. Market made a stand near that upward sloping 200-week moving average in 2022. A lot of white space between these moving averages and the 200-week. A lot of white space between these moving averages up here and the 200-week. That's not what you have here early in 2001. That's not what you have up here early in 2008. We could see this measure, put it in a model well before the balance of these declines. So in this type of mitigation 1, you're really trying to stay with the long-term trend. You're not trying to migrate to defensive assets. You're taking some defensive action in here in the event that this morphs into something more like 2000 or 2008. And you're willing to accept a drawdown here. Why? Because typically in these instances, if you don't overreact and you hold your positions, eventually they're going to go on and make a new all-time high because the trend is still in place. That's mitigation 1. Accepting that you're trying to mitigate the drawdown, but tolerate a drawdown because the number one goal, unequivocally, is to make money. It is not to avoid volatility. It is not to feel good. It's not to have the smallest drawdowns. You can do all of that, but it's going to be very, very difficult to make money. Back to the S&P 500 sectors. XLI, incrementally improving strong trend look. This is the best it's looked in a long, long time. This is the best it's looked in a long, long time. This looks a lot better than all of this back here going into Q1 of 2022. On August 23rd, tech still holding this uptrend here, and lagging utilities, lagging for a long period of time, finally starting to participate. And also, this is the best look in quite some time, which aligns with this concept here. And on a relative basis, we don't have anything yet that says our leadership has changed in a meaningful way. There are some cracks over here, so we have to keep an open mind about the possibility of some leadership shifts. But as we know, there are counter-trend moves in leadership. And in this environment, we don't want to get too cute. We don't want to overreact in the short run, but at the same time, we need to keep an open mind about leadership over the next few weeks, few months, or even few years. Right now, nothing has really changed here to say that this trend here is over. Anchored volume weighted average price lines still, for the most part, sloping up, and prices back above all of them. Do have an indecisive kind of weakening relative trend look in here that we have to respect. But again, after the Fed, every single sector was up on Friday, August 23rd. And your leaders, post-Powell, they weren't defensive. Consumer discretionary, energy, tech, materials, real estate. Laggards, post-Powell, defensive consumer staples, defensive healthcare, and defensive utilities. It's right over here. You may remember on August 2nd, we said it doesn't look like a market that's nervous about a recession. We can look at it this way. This is the S&P 500 relative to IEF, and you can see the migration concept here. This is telling you that SPY starts to significantly underperform IEF 7 to 10 year treasuries in this window. There's a divergence here. S&P 500 peaks in October of 2007. This ratio makes a discernible lower high. This is a market that's concerned about a deflationary recession and job losses and a hit to earnings. So how does the exact same chart look today? Are market participants saying, hey, the Fed's cutting rates because a recession is right around the corner? Looking like this up here, that would be concerning. You can see the chart that we have in the present day. You can make an argument this somewhat looks like that 1995 window. Indecisive back here, stocks versus bonds in early 2023. And since then, an improving trend look and a still strong trend look with a lot of white space between the moving averages. These moving averages are well above an upward sloping 200 week, and price is well above an upward sloping 200 week. Similar concepts in here, and I can't emphasize enough, we're not saying 2024 is 1995. We're saying the interpretation of all the fundamental data is similar in this window and in August of 2024. Before the recent decline, secular volatility scores, strong. As of the close on August 23rd, 2024, secular volatility scores, strong. Aligns with all of the charts that we've covered, aligns with the 92% up day, It aligns with the improving trend look, similar to the improving trend look after indecisiveness in 1994 and then in 1995 where the Fed started to cut rates. We're covering nothing here that contradicts the secular trend theory, and history tells us there could be a lot of potential upside left in this secular bull, emphasizing that if you want to be successful, you want to make money, even within the context of a secular trend, you have to be willing to tolerate drawdowns. Trying to sidestep every penny of a drawdown is absolutely going to harm performance over here. Exact same moving averages we've been covering, NYSE composite, breaking out of a long-term base with an improving trend look. This is the best look here in a long time. To summarize, secular trend firmly intact. Current data that we have in hand, technical, economic, supports the theory of a soft landing. We do have some subtle cracks that are there. That's not particularly abnormal. It's useful because it helps us keep an open mind about a wide range of outcomes. We also have to know that it's common for hard landings to look like soft landings, and then eventually they turn into hard landings. So far, this looks like a soft landing, but we'll see how it evolves, meaning we're making no assumptions about any topic on any time frame. We're getting ready to resume work on the secular volatility model, turn our focus to the markets 100% of the time and our existing clients, those three major objectives. And hence, the new client window that is currently open is going to close on Tuesday, September 3rd. That basically means you have to contact us by that date. If you've already started the process, this date is irrelevant to you. There's a ton of information that you can find, including FAQs, how to get started on our website. You can contact us via email using the contact link. All of this is in the upper right-hand corner of our website. You can Google or search for Shivako Capital. The spelling is in the lower right-hand corner of your screen. And if we want to be successful in terms of the objectives on the right side of this screen, we all know, incredibly important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.